So it's now my pleasure to introduce Professor Jane Knodell, who will give a talk titled Money Supply Endogeneity, a post-Keynesian monetary historian's perspective. Jane started her career at DU in the economics department when it was led by David Levine, Professor Emeritus, before he migrated over to the Joseph Corbell School, then GISI. She has also previously visited DU during the intervening years and was good friends with the late Tracy Mott, who she knew from her days at Stanford, where she earned her PhD. Jane Knodell has spent most of her career at the University of Vermont, where she is Mark J. Zwijnenberg Green and Gold Professor of Financial History and a Professor of Economics. A significant part of her career also saw her rising through academic administration, leading her to serve as Provost and Senior Vice President at the University of Vermont. Jane's teaching and research interests are in the fields of money and banking and economic history. Her research applies the tools of economic history, institutional analysis, and monetary analysis to understanding the evolution and performance of monetary institutions over time. She is currently working on a book project with Catalina Vizcarra about the interrelated monetary histories of colonial North and South America. So let's please all give a warm welcome to Professor Jane Knodell.
Thank you very much. I'm really very honored to be here today. I'll get over it, it's okay. I just really want to thank Dr. Schneider in the economics department for inviting me to speak at this important event. And it is a bit emotional, it's kind of coming home to a place that was very important to me as I was starting my career as an economist and trying to figure out my place as an economist. And I'm also very happy to have two friends here, Rona Rulensky, Carol Heim, colleagues and friends in economics. We have had many conversations over the years that have helped me think through my own thoughts and where and how I could move my ideas forward in economics. Many thanks to Kate for all the arrangements. It's been wonderful. And Dr. Cole has kind of gotten me through the day, and I appreciate everyone's very generous hosting of me. So let me get into my talk. So I'm using arrows? Okay. So I'm going to start on the work of John Fagg Foster. When I came to UVM in 1982, no one told me about J. Fagg Foster. And when I then was doing some research for this talk, I realized that, what an important figure he was in institutional economics. And I think established DU's kind of economics department's identity as a place where they wanted multiple perspectives and methods in economics to flourish. And I think that's been a very important legacy. Now, Foster was a theorist of institutional adjustment, and I wanted to share his definition of economics. He said this is from the Journal of Economic Issues, and I understand the person who put these papers together is here with us today. So in one of these papers, he says, the real burden of economics is the development of the theory of institutional evolution and the application of the theory to economic problems. You'd be hard put to find many economists that would define economics in this way, but I think it's a very powerful way to think of the purpose of economics as a social science discipline. Foster, instead of talking about institutional evolution, he talks about institutional adjustment. This idea of adjusting institutions to economic and social problems. And in his view, if we consider institutions to be a given and not subject to modification and just do our economics within the context of existing institutions, we will not be able to move very far in solving the social and economic problems that we face. So in my talk, I'm going to kind of connect Foster's idea, as I understand it, of institutional adjustment to monetary history and using also the post-Keynesian idea of money endogeneity. And I understand that students have learned about money endogeneity in your money and banking class, which is great. So I'll apply this idea to the monetary history of Western economies and with some focus on Anglo-American monetary history. And there will be 5 parts to my talk. I will start by talking about the idea of money endogeneity, okay? And then I'll also briefly summarize the debates that have gone on among post-Keynesian economists about money endogeneity before there were banks. And I'll let you know kind of where I stand there. And then I'll offer you 3 very stylized stages of monetary history for the purpose of explaining to you why I think that the institutional adjustment in the form of the creation of central banks has been very, very important to the full realization of money endogeneity in modern economies. Then I'm going to get into the kind of institutional adjustment part and share with you some of the origin stories of early central banks. Were they created to kind of solve, to move forward the kind of endogeneity of money in some way? And my answer is going to be not really, but they were then adjusted for that purpose. And then I'll talk about our own central bank, the Fed, which is a late central bank, very late central bank in terms of when it was created. And I'll go into some detail about the Fed, and then I'll come to a conclusion. Okay. All right, so starting with the idea of money endogeneity. And here I want to mention Gladys Foster's seminal paper. I think it's hard to find a paper that's better than this paper, published in Journal of Economic Issues in December of '86. As she connects the endogeneity of money to Keynes' general theory, and it kind of explains how his work is and is not kind of consistent with money endogeneity. So she states very clearly there that Keynes' macroeconomics is a monetary theory of production. It's not a real resource theory of production. It's a monetary theory. And I summarize that by this idea that money is necessary to finance production. So this idea that post-Keynesians have developed about monetary endogeneity was initially developed in opposition to and rejection of a monetarist idea that we summarized as the helicopter drop idea of money supply, in which money just kind of drops from the sky in a fashion that is very exogenous to economic activity, the level of economic activity, the level of investment spending, desired investment spending, and so forth. So in this monetarist idea, the production of output and the supply of money are very much two disconnected economic processes. But in the money endogeneity story, and Gladys Foster's paper lays this out very nicely, the way it works is that firms borrow working capital from banks to produce goods and services. So they need some advance finance to hire labor and buy supplies and pay the rent and so forth. And the banks make these loans. They make these loans by simply creating deposits, right? And this is, they're creating money as they lend, okay? And this new money, these deposits, circulate as the deposits are spent on labor, materials, and rent, and then continue to circulate throughout the economy. So there's this kind of interconnection between the money multiplier and the investment multiplier, or the government spending multiplier. These are not disconnected processes. They are interconnected. They're the same process. There's a monetary aspect to it. So that's how I understand the monetary theory of production. So Foster concludes that quote, "The fact that the quantity of money is determined endogenously does not mean that money is not important. If the process seems effortless, it merely means that the financial structure is working well." That's my emphasis. So as an historian, you'll hear some of this. I have learned that it's often the case that the financial structure does not work well. Okay. And that's kind of the crux of the kind of movement, the historical evolution, is trying to get the financial structure to work better. All right, so getting into the kind of debate about, has money always been endogenous? You know, even if you don't have banks, can you have endogeneity? So as I just said, in the post-Keynesian literature, which is really about kind of modern economies, money endogeneity is clearly linked to the presence of banks and central banks. So as I just kind of explained, loans make deposits. Okay. But then central banks are also important because central banks accommodate the commercial banks' needs for the reserves that they must hold to have enough liquidity behind the deposits that they're creating. So you also need the central banks. So in this debate, and Professor Yoon and I were talking about this earlier, there's the view, the very strong view on one side of the debate is that if you don't have banks, you can't have money getting created through lending. So before banks, money was not endogenous. There's no way. Okay. And then the other extreme was that no, money was always endogenous, even when it took the form of coins, kind of minted precious metals, because it's really just in its intrinsic nature to be endogenous, because it only comes into creation when someone needs it to carry out trade. Okay. So my view is somewhere in between these two positions. So here's my stylized history, and I'll kind of explain where I stand in this debate. So again, these are three very stylized stages because, the institutional details are very, there's a lot you can say about that, and sometimes you have, more than one stage in existence at one time and so forth, but just for conceptual purposes. And these are all just the supply-side institutions that create money. Right? So way back when, it was mints that produced copper, silver, and gold coins. Individuals, for the most largely merchants, would bring precious metals to the mint and get the coins, and then get them into circulation as they did their business. In the second stage, you had banks that created money through lending, but you have no central banks. And then in my stylized third stage, you have banks that are lending and creating money, and they have some central bank backup to that activity. Okay. So the question is, in how endogenous is money in all of these stages? And I'm currently now really very deep into what mints did. And it's pretty fascinating. We can talk more afterwards, So like the strong view took the position that, when you have mints, that the supply of money is completely dependent on the natural resource. Okay. So you have to have, more resource, if you don't get more natural resource, get more gold and silver, you can't get any more money. Okay. So what I think is that although, of course, the money is tied to this natural resource and was not created through lending, we still see aspects of endogeneity in the sense that the money supply did grow in response to the requirements of an expanding economy. Okay. So you can invest in new mines, you can bring new technologies to being able to access resources that you couldn't access with old technologies. you could obviously open new mints, and there's also lots of technological improvements to coin production, which can allow you to be more efficient in your use of the natural resource and so forth. But then there's also the fact that you can devalue your coin. We simply declaring, the officials, whoever the authority is, declaring that each shilling now has less silver than it did before. So that allows you, with the same amount of silver, to produce more money. Because money is always in the unit of account, right? Which is tied to some political body, okay, and group of people. And then what I really love is what's called enhancement. So larger coins actually had no denomination printed on them. And so what the officials could do is simply declare that that coin, which used to be worth 5 shillings, is now worth 10 shillings. So you've created more money without having any more natural resource. So it's overstating the point to say that the money was completely inelastically supplied, right? There was still that responsiveness in the supply system. There were supply problems, though, rooted in the dual nature of commodity money. So silver coin had a dual nature in the sense that the silver itself had a value as a commodity, as bullion, and there were markets that valued the silver, and it had its value as just the means of payment. And whenever its value as the bullion was greater than the value as the means of payment, you would melt down the coin and sell the coin at its market, the silver for its market value. So this is a supply shock. This is a reduction in the money supply that is not connected to any reduced level of economic activity. Okay? And the economy has to adjust to that. You also had these competitive devaluations among neighboring polities where a group that wanted to attract more silver would increase the mint price for its coin, and that would attract silver from neighboring communities and causing money supply in those areas to contract. And then there were chronic shortages of small change in particular, which I thought it was important to mention. So people that needed small coin to do business were very much affected by the sheer inability to get coin of the proper denomination to carry out their daily material lives. All right, in stage 2, we have banks that created money through lending, no central banks. So here, money was, historically it's the case that in these early forms of bank money were always convertible into specie, by which I mean gold or silver coin or both, at a fixed rate that was set by political authorities. And I think that was like a confidence building device, in the sense that you're moving from a money form that is real and that has a commodity value to it, right? So even if you lose confidence in the authority that's minting the money, you still can sell this for something real, okay? So now we've got paper money. It's a very abstract form of money. How do we get people to have confidence in it? I think this idea of you can go to the bank and get real money for it was important. It's created through lending, and whenever you have money being created through lending, you have to have fractional reserve banking, right? Otherwise, if all the money is just backed by the specie, there's no ability for the banks to actually lend. Okay. This, though, the fractional reserve banking, as I think everyone is very familiar with, exposed individual banks and the banking system to the risk of bank runs, in which if you start to worry about whether your bank's money is actually sound, you will go and you will withdraw those deposits in order to get the cash, a gold coin, instead. This is very likely to develop into a bank run, that is to spread from bank to bank, because depositors have difficulty in figuring out the difference between good banks and bad banks. You know, if that bank over there, you know, isn't able to meet all the demands for specie, then maybe I need to get specie out of my bank too, because I don't really know, you know, if I can trust this money anymore, right? And in addition, there's this thing that we call the first come, first serve rule, where the first people to show up are the ones to get all their cash. And if you're back in line, you're probably not, you may be left holding the bag, right? Okay. So in the national banking period in the United States between 1863 and 1913, kind of just notorious for all the banking panics that they endured. So just to explain what national banks are for a minute. These were national banks in the sense they were chartered by the US government that also supervised them and guaranteed their notes, but not their deposits. The idea was that depositors should be able to take care of them, kind of do the research to know which banks to trust, but note holders, which are largely people who did not have relationships with banks, we needed to kind of protect them. Recurrent periods of banking instability in which we had a large number of bank failures, which resulted in the destruction of money, which is also a supply side shock. You know, when a bank failed, their money, the value of their money, went to zero or near zero. Okay. And this was the period before deposit insurance, and so, you know, people just would lose their savings during these bank failures. I have you can ask me about, like, you know, really people lost everything, and there were some mechanisms they put in place, but let me move on. Sometimes banks would restrict their cash payments, saying, I'm gonna only allow you to withdraw $10 today. So it was a kind of a way of rationing their cash, which still created problems because businesses in particular, in these cases, were actually unable to meet payroll, okay? So businesses actually closed their plants because they couldn't get the currency to pay the wages. And so that kind of forced reductions in production levels and income generation. So you have in these panics the scramble for cash with no or very limited mechanisms to inject cash into the banking system to kind of calm things down, stop the run, which is where I think that central banks are very important. So in this kind of third stage, when are these scrambles for cash and banking panics, central banks will supply new cash, and if they're competent, they know exactly where to inject the new cash and when to inject the new cash, and they're able to inject enough new cash to meet the requirements of the time. This kind of central banks that are able to fully meet these scrambles for cash have to be liberated from the tie to gold. I'll talk a little bit about what happened in the Great Depression. And in this stage, central banks eventually replace the gold standard as the anchor to domestic monetary systems, and central bank money replaces the gold as the reserve currency in the banking system. And central bank money itself, in my view, has to itself be highly endogenous and expansive in order to really get to the kind of full form money endogeneity that we experience, kind of maybe take for granted in our daily lives. So central banks are very important. Somehow central banks were created. I think Foster would say that was a big institutional adjustment. Okay. So as a historian, I'm always wondering exactly how did that happen, right? These are important. Why were these early central banks actually created? So I want to talk some about the origin stories of early central banks. All right, so by say early central banks, 17th century to 19th century, and these early banks were not established for the purpose of solving the problem of bank runs. they were set up for other purposes, and there's a variety. Some of which have to do with an insufficiency of a supply of money for some sector of the economy. But then there's also many cases where these early central banks are set up to improve the quality of money. So, Bank of England, very, often thought of as like the first central bank, although there's a lot of debate about, was it the Bank of Amsterdam, was it the Bank of England? It was an important early central bank. And the first two banks of the United States were set up for war finance purposes. Then there are a number of European banks, central banks, the Reich Bank, the Bank of Italy, Swiss National Bank, were set up as those nations were formed in order to have a unified national currency. Okay. And then the Bank of France was actually organized by a coalition of Parisian merchants in 1800, and the currency was a mess after the revolution, the French Revolution, and they were trying to stabilize the currency, to kind of create a money that could actually would hold its value as it was used. And so these are, I want to go into a little more detail about the Bank of England and the US cases. So these early central banks, set up for purposes other than dealing with bank runs, were later adapted to the problem of banking instability as they encountered banking panics, and then someone said, someone's got to do something, the Reich Bank, it's your job, and their kind of missions evolve and expand over time. So the Bank of England, established in 1694, was established when one of the many times that England was at war with France, and the English government actually was a distressed borrower. The private sector was kind of like declining to hold its short-term debt. Its short-term debt was going to higher and higher discounts, meaning the government was having to borrow at higher and higher interest rates. And it came that the Bank of England was formed when a group of wealthy London merchants went to Parliament and said, we can solve your problem. We will collectively subscribe to a loan to the government with no maturity. So we're not asking you to tell us when you will repay this loan. A feature of the loan that was at the time very attractive to the English government. And in exchange, all we're asking for is some banking privileges. We want to be able to issue our own notes as money. Okay. And they were taken up on this deal. They actually had a short charter, but every time this charter came up for renewal, they were able to the government was again in need of an institution like this, and it became obviously a very long-lived institution. And its notes became regarded as gold equivalents, and it was established firmly on its own legs. And the Bank of England, though, only took on the role of lender of last resort in the late 19th century, 200 years after it was founded. So again, it took a long time for it to turn into a central bank through a process of institutional adjustment that Foster would talk about. So I've done a fair bit of work on these early central banks. The first bank in the United States was part of Hamilton's plan to put the US government on a sound fiscal footing, just kind of almost a decade after the end of the American Revolutionary War, and the US government was not in good shape. The first bank was the fiscal agent and banker to the national government. It was provided a better form of money for the collection of taxes, which was the primary revenue source for the national government. And an important part of the kind of US Constitution was that the authority to levy customs taxes, which had rested with the state governments, was moved to the national government, which at the same time assumed all of the Revolutionary War debts of the state government. So that was the deal. And that was being able to levy the customs revenue made it impossible for the U.S. government to be a credible borrower, right? Because it would have a tax revenue to actually service the debt and the interest payments that the debt was involved. Okay, so this money, because we're here to talk about the quality of money, what were the alternative forms of money? Well, you had the paper money that was issued by the state governments that in 1791 were all denominated in the pound, local pound units. So there was the Pennsylvania pound and the New York pound and the Maryland pound. Okay, so that's not going to work for, you're trying to unify, again, the kind of monetary system, and you're looking for money that's denominated in US dollars. Okay. Better than the specie, there was not enough coin, and all of it was in foreign monetary units. And it was better than the money that was being issued by state-chartered banks that were attached to their state governments. So basically, Hamilton said the national government needed a bank of its own, and that's what the first bank was. And it's also pretty much what the second bank was. Again, established post-war, and this time after the War of 1812. And it was set up very similar to the first bank in the United States, but it had a branch network. Now, in 1816, geographically, the United States was much bigger than it had been in 1811. And so what the second bank did, in my view, what was especially important, was dealt with the problem of making payments over long distances. So it would use its branch network to efficiently collect revenue and make disbursements across this huge territory. And again, this second bank money was better than the notes of the state-chartered banks, and it was better than specie. Now, I wrote a book about the second bank, and everyone who had written about the second bank said second bank was a central bank. And so I was like prepared to, I was like, okay, I'm down with that. I'm going to write about this. But the more I got into it, and this is the fun part about research, is that you have to sometimes let go of the things you thought were true. And what I learned about the second bank is that it was most definitely philosophically opposed to having a lender of last resort, much less it being a lender of last resort, and just felt very strongly that the state banks needed to provide it for their own liquidity. They didn't want to set up a system where the banks knew they could get any other liquidity that they wanted. So this is like an early anticipation of the moral hazard problems associated with lender of last resort and other stabilizers. All right, so the Federal Reserve was established in 1913. It was a late central bank. Unlike these early central banks, the Fed was in fact founded to address banking instability. So, there was a problem. There was a very, kind of serious panic in 1907, which was, I say it was serious because it was long. It was much longer than the earlier panics had been. And one of the kind of political breakthroughs that made the Federal Reserve Act possible was that the New York banks, which were increasingly responsible, in effect, for being lenders of last resort and stabilizing panics, were ready to hand that off to somebody else. Okay. And that was part of the, breaking through the political resistance to having a central bank. That is very much deep in the kind of ethos of the U.S. history of, we don't trust these large centralized institutions, especially if they're based on the East Coast. But it took many decades for the Fed to become an effective lender of last resort. And I want to go into a little bit of detail on that, starting with talking about the 1913 Act, and then the amendments to the Act in 1917, the Fed's dismal performance in the Great Depression, and then jump forward to the Fed as a lender of last resort today. Okay. So, the Federal Reserve Act of 1913. I wrote a recent paper about this for a review of political economy, and learned a lot of things about that I didn't know. Okay. So you had nationally chartered banks at the time. You had state chartered banks. My view of the Federal Reserve Act is that it essentially set up the reserve banks to be a third sector of the banking system. Not to be a central bank, but to be a third sector kind of alongside the national and state chartered banks. The idea was that the reserve banks would issue Federal Reserve notes, the ones that we carry around, well, the older people, at least some of us carry around, provide temporary emergency currency to member banks with eligible collateral. The currency would be withdrawn after the panic. So it wasn't the idea that the Federal Reserve notes would really be a permanent part of the circulation. They would just be injected when you needed them, and then they would be withdrawn. There was no broad lender of last resort authority in the 1913 Act, and the member banks were required to continue to hold a significant portion of their required reserves as gold, not as balances with reserve banks. Now, I had always thought that from the very beginning that the reserves had to be held all as balances at the Fed. That was not the case. And the people who put the Federal Reserve Act together, Stegall in particular, felt very strongly that banks should continue to hold gold as the reserve, and kind of, because we were still on the gold standard. All this money is still convertible into gold at a fixed price. And they wanted all those banks in the country, even out here in Denver, to be able, well, Denver may be easier because you had a little gold supply here. They wanted them to be able to all meet that promise to convert their money into gold at a fixed price. So, April 1917, the U.S. enters World War I, and there are some major amendments that are made to the Federal Reserve Act that would have deep significance for the Fed being the Fed that we know today. So, and in my view, none of these changes would not have happened without the kind of war emergency, the need to do something to allow the federal government to borrow on a scale at the time unprecedented, many, many scales larger than any borrowing that the U.S. government had ever done. So the primary change was that the reserve banks, it was now legal for them to lend to member banks on collateral of U.S. government debt. That was not allowed under the original act. So what would happen was there was a very rapid expansion of the reserve bank's balance sheets as they're lending to the member banks on collateral of government securities, and allowing the member banks to absorb government debt and subsequently be marketed, further marketed throughout the population. Now, these changes, these war finance-driven changes, had the effect of repositioning the Fed as a central bank, not just like this third sector I was talking about before, to the dismay of some of the members of Congress that were most involved with the drafting of the act. But very much there were some players within the Fed who had been pushing for these changes from the time that the Fed got established. Benjamin Strong, Paul Warburg, who had been very successful and kind of experienced bankers in New York in the private sector, and they kind of got into, Strong was the first president of the New York Fed, and Warburg was on the first board of governors of the Fed, and they're kind of sitting there, and I've read their correspondence, which is fascinating, and they're writing to each other, and they're saying, how are we supposed to run a bank under these rules that they've set up in the 1930 Act, right? And so they've had all these amendments that were ready. They'd been lobbying Congress, So they finally get these amendments that say, okay, member banks, required reserves, the only form in which required reserves are to be held are as balances with reserve banks. So it's like you can still hold your gold and stuff, but none of that's going to count towards your required reserve. So you see this very rapid kind of member banks say, okay, I'm going to take my gold and I'm going to go deposit it in my reserve bank because it no longer counts toward my required reserves. So as a result, Federal Reserve money, essentially replaces the role that gold had in the banking system, and gold gets really centralized within the Federal Reserve system. Okay? We're still on the gold standard, but the gold is now largely held by the Fed and also the U.S. Treasury. So that's an important moment in like moving money off of gold. Okay, is that the general population and banks don't really see much purpose in having it, using it. So in the Great Depression, the Fed had the right tools but failed to use them very well. And this is a huge literature which I've kind of boiled down to one slide. So one problem was that only member banks had access to the Fed's discount window. But in the early banking panics, the deposit withdrawals and the bank failures were starting in the agricultural and kind of ranching areas of the country with small banks that were not members of the Fed, most of them, state chartered. And it's quite clear that the Federal Reserve thought, not my problem. These aren't our banks, not my problem. Of course, it became their problem. They now open market operations in which reserve banks buy U.S. government securities would help all banks, any bank that held government securities in their portfolio. It would be a way to get liquidity, and they would buy it, it's injecting new liquidity into the market for government securities, because they would buy the government securities with new central bank money. And it's supporting the price. You don't have to sell at a huge, at a huge price discount. So the literature talks a lot about, well, why didn't they could have done open market operations, but in effect, they started them too late and they ended them too early. And just to, why was the failure? And again, there's a huge literature, but first the Fed was worried about gold outflows, because if the U.S. interest rate falls too much below other countries, you're going to lose gold. And secondly, there is very decentralized power within the Federal Reserve System, both in terms of between the Board of Governors and the banks, reserve banks, and among the reserve banks. So we can go into more if people are interested. What did bring about recovery? National Deposit Insurance, Federal Deposit Insurance, established in 1934, which we can kind of think of as an institutional adjustment to the Fed's failure to be an effective lender of last resort. Adopted in 1934. Previously, we had deposit insurance, but only at the state level, and many of them went bankrupt. FDR, also I think FDR's gold policy was very important. FDR, by the way, did not support deposit insurance. Didn't like the idea. But what FDR did do is he suspended the gold standard, saying we're not going to, honor, especially foreign demands to pay gold. That's done for a while. He increased the U.S. dollar price of gold from $20.67 to $20.67 an ounce to $35 an ounce. It's a devaluation. It was a one-time revaluation upward of the value of the gold stock that was owned by, at that time, much of it owned by the Treasury, because the Treasury is actually getting the Fed's gold. Treasury needs to own the gold, and that appreciation of the gold went into the Exchange Stabilization Fund that some of you may have studied in your international finance class. I wanted to get some international thing in to kind of follow up on the theme from earlier. And they also limited private sector holdings of monetary gold. They said there's a limit to how much monetary gold you can own, folks, and anything over X, you need to bring it in, to your nearest sub-treasury, and we'll give you a piece of paper, acknowledging your, so, you kind of think about the extremes to which government power was used, in that setting. So there was a very late start to the Fed's career as a lender of last resort. There was very little banking instability until the 1980s. In part, the kind of many changes to monetary institutions were made during the Great Depression, which created a very stable monetary system during this, the golden era of U.S. capitalism. But that all kind of fell apart in the 1980s. So the Fed didn't have very much opportunity to learn how to be a lender of last resort. But clearly, in the global financial crisis of 2008, the Fed really flexed its muscles as a large and innovative lender of last resort. And you've probably learned in your classes, students, about all of the new programs that were set up to, in the commercial paper market, to help the money market mutual funds. And these were all using authority that the Fed got in 1932. The Fed didn't use it in 1932. But it's extremely broad language. And I always think some lawyer was really smart, That was really good because it's important because you can't have the Fed or any central bank be an effective lender of last resort if when they see a new need and want to set up a new lending program, they have to go to Congress and ask if it's okay if they do that. That's just not going to work out very well. So we saw an enormous expansion of the Fed's financial safety net, well beyond just the depository institutions it had historically served. And then the Fed, recently showed how they would do this in the recent case of Silicon Valley Bank. But I'm going to just kind of jump forward on this, and we can, if there are questions, I can go into to tell you more. But today, the Fed is really a very seasoned lender of last resort, and sorry, I don't want to make sure I don't go too long. So, what do we learn about central banking and institutional adjustment towards monetary endogeneity? So, I've talked about two different kinds of adjustment. One is creating new central banks, and then the other is in adapting existing central banks to meet new problems that come up. Early central banks were established for purposes other than providing liquidity assistance for banks, including improving the quality of money. So not just addressing problems with the supply, the quantity, but also the quality of money. And then over time, they took on central bank responsibilities when they were confronted with banking instability. The Fed was actually established for the purpose of preventing banking instability, but it has taken a long time to get there, right? So the Act did not create a bank in 1913 that was positioned at the center of the banking system. It was not up to the task of responding to the waves of banking failures in the 1930s, but did successfully meet the challenge of the global financial crisis. So how did, thinking about all these case studies I've kind of touched upon, what can we say about how the process of institutional adjustment worked? So it seems to me in each case, there's some important sector of the economy or the polity that has access to political decision makers that they take their problem to. And these sectors experiences either a monetary constraint or a problem with the quality of money. So this would be the English king in 1694. King did not have the authority to set up a central bank. That was Parliament, okay? But he obviously has good access to Parliament, and they were very well aware of the problems, so he is kind of a key player there. The New York banks in 1907, of course they had their own ideas about how it should be set up, which ended up not really happening, but them needing a central bank was an important piece of the Fed being created. The US government itself in 1917 led to those important amendments, and major financial institutions in 2008. I think, there were phone calls, many phone calls were made about, we're in trouble here, you gotta do something. So the solution that is generated for the sector or the entity that's feeling the pinch, feeling the problem, results in the expanded monetary capacity, or better money, for the economy as a whole. So the money supply endogeneity is very much a macro idea applied to the whole economy. So solutions for individual sectors get adapted, and then they turn out kind of expanding the capacity of the monetary system for the entire economy. So that closes my comments, and thank you very much for your kind attention.
I was enraptured and didn't keep good track of time, but we do have 5 minutes. If somebody has a question that I haven't answered, I can give it in 5 minutes.
Why didn't FDR like deposit insurance?
He didn't like the moral hazard problem that it created. In other words, he thought that when a bank gets insurance, that it will take more risk in its lending than it would if it didn't have the insurance. And the kind of larger banks, the kind of big New York City banks, also did not adopt deposit insurance because they felt it would be the smaller banks that benefited and they'd be paying for it. Okay, sorry. Thank you. Sorry about that. Yes, Charles.
You talked in your presentation about the futility of open market operations for the Great Depression being too late. In accordance with commentary from Keynes and Friedman on Benjamin Strong being a modern central banker that could have perhaps remedied the Great Depression in a different way, do you think had he not died in 1928, being untimely,
Yeah.
could have altered the outcome of that?
Right. What if Benjamin Strong was still around during the Great Depression? That's a great question. I mean, who knows? But I mean, Strong was had a lot of influence within the Fed, obviously, and I think people on the Board of Governors actually kind of resented him. So it's an open question. I mean, it might have been that people just saw any suggestions that he had as being for the interest of good for the New York bankers, but not good for the Chicago bankers, right? And some of the decentralized problem had to do with, there's a lot of tension between Chicago and New York. There's a run on the dollar, basically, at some point, and that is really felt by the Federal Reserve Bank of New York, because that's the international center of the monetary system. And so the New York Fed is seeing that they maybe are going to run out of gold. And so they asked Chicago, sitting on a lot of gold, will you please lend us some of your gold? And Chicago says, yeah, I don't think so. I think we're going to need our gold, So it's all a question of, he may not have been able to make much of a difference. But there's a lot of discussion in the literature about this, and I think Friedman, thinks that was an important part of the problem.
One more last one. Well, then please, another round of applause.
Okay, sorry. Yeah, thank you very much. Appreciate it. Thank you very much.